Welcome back to another episode, and today I'm once again joined by a very special guest. Ole Hjertaker is the CEO of SFL. SFL is a unique company in the maritime industry and has paid out dividend every quarter since 2004. In this episode, we cover how Ole got interested in shipping, how he ended up working for John Fredriksen and scaling SFL, how to survive the cyclical nature of shipping, and what's next for SFL and their diversified fleet.
I think it's all about passion. I mean, to anyone who wants to get into any career, go with your heart, because that's when you do a better job. As a business mentality, you should be focused on what you've done wrong, simply to understand the dynamics of how the market works. It's a combination of greed and paranoia.
Let's start the episode.
Being a Norwegian, shipping has always been exciting. It's been, the way out of Norway, so to speak, a small country with a long coastline. I'm from the west coast of Norway, from an island outside of Bergen, which means that you always see vessels go past. And when I grew up, we had several large VLCCs in layup, just a few kilometers from where I grew up. So I would say that was a daily, view looking out at those vessels. Huge vessels. Some of them actually came straight from the shipyard into layup. And it's in many ways it's also interesting if you see the link to our main shareholder, Mr. John Fredriksen, who owns 20% in SFL. He made a fortune. This is back in the 80s when he was buying several vessels that were in layup, where he bought them for essentially just the value of the fuel on board. Because at the time, people were concerned that they were just too big, that they couldn't be utilized anymore after the energy crisis at that time. And this really illustrates the cyclicality of shipping, where you have sort of a boom-bust type structure in it, which makes it very appealing. From myself, I stumbled into it in a way. After my national service, I got a job in a small shipbroking company in Bergen. So when I started studying at the Norwegian School of Economics and Business Administration, I ended up being active in the in the shipping business group there. And one thing led to another, and I ended up in shipping. Started first at DNB on the financing side, moved over to the corporate finance side, and then I moved over to SFL now 16 years ago.
What's the biggest toolkit you get when you start working for the banks? Because you obviously see a lot of deals, you see a lot of companies. What do you think is sort of the toolkit you gather from going finance first, then over to shipping? Because as you mentioned, shipping is cyclical. It's big amounts of money going into ships, and you need to sort of understand finance at a very sophisticated level. So what do you think was sort of the toolkit you gathered working on the banking side? Was it just that you saw so many patterns and deals, or was it something specific in terms of calculating the different strategies and investments, etc.?
Of course, you see one side of the business naturally. I mean, you do a deal and then you walk away and you hope it will perform and you come back. And also what I think is it's a good way to train yourself in working in cyclical industries, in working in a financial or in a bank or finance institution. Because remember that the upside for the bank is to get the money back with interest. I mean, that's all they get. While investors, on the other hand, they get everything else. And of course, they lose everything if it goes the other way. So apart from learning sort of the basics of ship financing and financing in general, I moved over after a couple of years into more sort of special, call it situations, which is in many ways more interesting because that's when you start dealing with call it situations that doesn't go exactly as planned, and where things start unraveling, and that in many ways was a very interesting lesson. And then when I moved over to the investment banking side, it was a combination of doing deals, putting deals together, trying to understand what makes an interesting transaction for financial investors, etc. So you could say, I think it was an interesting way to get into it for myself.
Super interesting. So, many people ask questions, what makes a great investor, what makes a great shipping company, etc. But sometimes it's as interesting to flip the equation and say, what makes a terrible investment, what makes a terrible investor, and sort of like avoid those mistakes that can lead to bankruptcy. So when you are working on this sort of like, I wouldn't maybe call like SWOT operations on bad deals, do you see any patterns? Is it just over leveraged, or is it also people who, ride the cycles and, timing, you can plan timing and hope for timing, but sometimes the timing is just against you, right? So did you see a pattern on mistakes not to do when today, you make investments and, are into the market and actually have to commit by the investments you make on vessels, etc.?
Absolutely. And I would say if there are two skills that is essential, to deals, in the shipping side, I would say in cyclical business in particular, or maybe also in business in general, it's a combination of greed and paranoia. You have to be greedy, of course, because you want to get the deal done and you want to make a return, but you have to be focused on everything that can go wrong and manage that risk along. Because what we have seen over the years is that there are so many deals, and when people come to you with a business proposal, you see that hockey stick expectation. It's thin now, but it's going to be phenomenal. We're going to own the world. And, surprise, surprise, very few of those projects actually end up looking like that. But some do. So it's all about finding the deals and trying to do the deal you feel is right from a risk-reward perspective. So just as an example, in SFL last year, we did just about $1 billion in new investments. But we did look, I would say, closely at investments worth $19 billion. So you could say, round numbers, we did sort of 1 in 20 of the deals we actually spent real time on, not, where we modeled out, etc. And this is something you just have to do. Every new deal, you have to go at it with the mindset that this might be it. This might be the deal that really makes sense. And then you start digging into it. It could be vessel technology, it could be the segment that it doesn't work right, it could be the financing structure, etc. So there are always many things that you have to look hard into when you make an investment, but you have to combine greed and paranoia. Otherwise, you're almost doomed. If you're too paranoid, you won't get a deal done. And if you're too greedy and don't have the paranoia, you will lose it all most likely.
When you're doing these investments, and we have seen, the COVID situation, I mean, very few people forecasted that one. And then there's I would say a sophisticated debate if it's a black swan or not, but it doesn't really matter when many people haven't, calculated a big global pandemic. And then you, of course, have the war right now. So, I mean, when you buy investments and vessels, it's easiest to create models of known knowledge or experience, but how do you also calculate the unknown, if you know what I'm saying? The things that hasn't happened, but it could happen, maybe in a crazy scenario. But still, if that scenario hits you, it's very difficult to be a ship owner.
Absolutely. And it's a very interesting question, because I would say, the black swan, as you referred to, I would say in shipping, black swan is really more something you should expect. It's not something you should be that surprised over. And the reason why is that you are combining a cyclical market. Remember, shipping is moving raw material for the most. Of course, containerized goods is a little different, but the basic sort of dry bulk, and tankers, that's moving of raw material from one place to another. It's a very cyclical underlying market for the commodity itself. And then you combine, call it operational leverage or operational volatility with financial leverage. So you could say it's a cocktail that's that's almost a recipe for disaster. And the problem we have in the industry at large has been, access to funding, access to cheap capital. Which means that if you combine, if it's so tempting to lever up, because that's when you get the super return on the equity. If you have a nice, say, 50% upswing in values, and you're levered, 5 times, it's phenomenal on the equity return. But also at the same time, when things go the other way, you will lose it all. So I would say that's the bigger issue with shipping as an investment, or as an investable asset or asset class, is that we've seen it too many times. Unless you are sort of a specialist who's following it day to day, if you're a ship broker, you follow it very closely, or if you have sort of some special sort of interest, so you do follow it, then you can really sort of play that market. Then you might be able to get out early. But for most investors, and for SFL, for instance, we have around 60,000 investors, predominantly US-based, most of them retail investors. And you cannot expect that all of these investors will follow sort of the spot tanker market or the spot bulker market from day to day. So we've seen so many examples, in the capital markets where, people have been, or investors have been, I would say, brought into investment cases, and it's turned out to be very, very different. We have some examples in the market out there today, companies who raised money, say 9-10 years ago, where, we're down 99% from compared to the initial investments and compared to where those investors came in. Of course, that will spook most people. So what we try to offer in SFL, we try to offer, call it, I would say, a safer investment, or certainly a better structured investment, so you don't have to necessarily follow the spot market from day to day. So what we focus on is lower operational leverage, which means we have most of our vessels on longer term charters, and then we can have financial leverage, i.e. borrow money. If you have high operational leverage, i.e. you run your vessels in the spot market, you should be very, very careful with the financial leverage, because that is it's the combination that will take you down, and that we have seen over the years have taken down most of the shipping companies.
Today, there are apps for basically everything. Planning your day, ordering coffee, booking a taxi, working out, cooking, ignoring, commuting, getting directions, connecting. While the world moved on, investor relations didn't. Even today, finding relevant information and connecting with the companies you care about is time-consuming and analog. Until now, because now there's Quarter.
Nice.
Quarter, bridging the gap between companies and investors.
If you take an analogy in sort of like a specialized hedge fund versus an index fund, do you think that's a fair analogy on SFL, just given that, since it's a more broad portfolio, you maybe don't get the huge swings on the up and down side, but you get more stable, growth trajectory? Or do you think that analogy is not fair at all?
Well, we don't hedge in the form of shorting, so we don't go long one sector and short another. Yep. We don't invest. That's how we try to do it, and we try to be careful. And I think one of the benefits of looking at multiple segments at one time is that you sometimes see patterns in segments. For instance, if one segment is rallying, and we know that from the past that it's typically in the peak markets. That's when the capital market is open. And the reason why, and that's when you can therefore do deals, and that's where, if you are focused on one single segment alone, you're almost programmed to invest at the peak. And sort of the good old shipping 101 is buy at the bottom, sell at the peak, or as close as you can get. But in reality, for the companies in the I would say listed companies who are in the capital markets, they're almost programmed to do the opposite. Because they have to follow the market, and they have to put money to use when money is available in the market. So that's one of the things we try to counterweight in SFL. So at any given time, we will look at deals in the container space, in the tanker space, in the dry bulk space, and also we've done some deals in the offshore space. So it's all about trying to balance it, trying to find the right risk-reward mix, and invest with a long time horizon.
Can you talk a bit about the asset classes and the weighted portfolio, because it has changed over time, right? And right now it's very many liners and container ships you are releasing out, etc., and buying. So How do you calculate that? Because is there like a strong correlation in how much percentage? Do you balance the percentage as a hedge fund guy would do if he was an asset class investor? Or do it always comes back to, is this the right deal? Then we'll take it. Or is it, even if it's a great deal, you can't take it because the portfolio then gets outweighed in terms of what you want to have in your portfolio? How does that work?
Yeah, I think, if you start planning with a certain percentage in each segment, it's a recipe for disaster. It's all about trying to do the right deals at the right time, and that's where that's one of the benefits of looking at several segments is that we can try to look at the segment. If one segment is red hot, i.e., values have gone sky high, then you can pull back and you focus more on other sectors. If you look at our portfolio mix, it's been a very interesting change over the years. Back from the start, 2004, SFL was a spin-off from Frontline. We owned only tanker assets. We had 47 or 48, I believe, at the beginning. We're basically a captive financing arm of Frontline. Back then, this was actually, I would say a very, very smart move. This was on the back of, the baby boomers in the US, where you saw a shift from call it classic sort of value and growth stocks to more dividend type stocks. You saw the hotel industry, for instance, where you have a distinct different ownership in the real estate and in the operating companies, sort of OpCo, PropCo type mix. But in the shipping, all shipping companies own their assets and run them in the market. So the question that Mr. Fredriksen and his co-workers then had was, why doesn't this work in shipping? Why don't you have the same OpCo PropCo separation? And how can you attract a different set of investors in the shipping community compared to the hedge funds of the world who normally have invested in the shipping space? So SFL was created, I would say, as a first in the maritime space. A couple came later. You have MLPs who have, I would say, sort of similar characteristics. But I think SFL, what differentiated SFL was that it was set up not to be exploited or not to be just a sort of a drop-down type vehicle where, call it the principal sort of investor, could gain a nice profit. It was set up to be independently, call it profitable with a profit share mechanism relating to the tanker market at the time.
It's very interesting because if you look at the homepage, it says like 3 keywords. It's growth, profits, and dividends.
Yeah.
Is that sort of like the most simple way to describe the company? If you manage to do those 3 things, that's basically the job.
Yeah, absolutely. So if you go down back to the tanker side, we started tankers, started investing in other sectors, and I joined in 2006, first as CFO and then as CEO from 2009. So when we joined, it was a year or two without much activity in the company itself. It was really managed by Frontline. So then a management team was brought in to set up, to really develop the company into, to do something more out of that, call it vehicle that the SFL had become at that time. So then we embarked on a strategy where we diversified the portfolio. We invested also in other segments. So by 2009, we had more in the offshore space than we had in the tanker space. At that time, we had close to 60% of our portfolio in the offshore space. We had a lot of tankers, of course, and very limited container ships and just a small portion of dry bulk. So zooming forward, now we have much more in the container space. We don't have much in the offshore space. And, interestingly enough, just 2 weeks ago, we announced the sale of the 2 final Frontline vessels. So no, we have no vessels left from Frontline from when the company started. So it's transformed itself. Maybe also illustrating, the boom-bust dynamics of shipping. We started as a captive financing arm of Frontline in 2004. In 2011, because of the financial crisis or the crisis in the tanker market, we ended up being the largest investor in Frontline. So at the time, and then for those who remember, old Frontline was merged with Frontline 2020, and of course it became a very different and much bigger entity after that. But just illustrating the dynamics, in the market.
What has been the worst investment you've made during your SFL time?
Good question. Of course, you would hope that you shouldn't have remembered it, but of course you do, and I would say, as a business mentality, you should be focused on what you've done wrong, simply to understand the dynamics of how the market works. I think the worst investments is probably a drilling rig that we bought for $850 million in 2008. We earned a lot of money on it because we have a very front-loaded charter, payment structure on that. So we basically recouped most of the money without any return, but we ended up scrapping it, in 2021, just 13 years old, and got, next to nothing, i.e., recycling value for that after such short period. Of course, many years that market was booming. That rig was chartered to Seadrill at the time. The head charter was phenomenal. It was at 6 years to Petrobras at $640,000 per day. It was just insane, call it net cash flow. But unfortunately, when the offshore market crashed, it had to be laid up and in the end recycled. So, but I'm sure there are many other investments that could have been better. But it's also investments that I would say may, during the life cycle of that investment might have looked like, oops, this could be an issue, and where the market pops back up again. For instance, we have some container ship investments with that type of characteristics.
But isn't that super interesting? Because obviously when you look back on time, it's very easy in hindsight to see what were a good and bad decision. But when you're taking a decision, you don't have the fortune on looking back after a 10-year period. And that also brings up the question, how much destiny control do you have? Because we talked about the market, super cyclical, very hard to predict. I mean, you showed me charts that says that like timing is everything, and transaction isn't every day. So you have to sort of swing with the market at times. So in your own sort of mental mind, how comfortable do you need to be in bad times and not get panic, and also say that this is part of the job? Because in other businesses, you can't just, if you grow a SaaS company, you can easily grow that if you have, the right customers. You can grow that, predictable for many years without having the boom and bust, right? So how does that play in when you are the CEO, when you need to answer for the portfolio at a given month, but that also that month is based on a terrible market, right? So that has to be an interesting dynamic as a CEO to be responsible for that portfolio going through those ups and downs.
Absolutely, and that's where the greed comes in. Because without the greed, you would just be paranoid. If you look at how the shipping market has developed over the years, it's very easy to be just be paranoid, and then you won't get the deals done. No, if you look at sort of the market dynamics generally, I would say that it's you have to have a mindset when you make an investment. And what we do typically, we focus on, one, we are very technically focused. We focus on technical developments, and we try to be ahead of the curve on that side, because if you have technology shifts, you have to be very careful with how you invest. For instance, on the container side, you had a technology shift after the financial crisis in 2009. So any container ship that's designed before the financial crisis, i.e., and those are vessels that are delivered all the way up until 2011, 2012, they are all technology as we see it. It has to do with the engine configuration, it has to do with the hull shapes, versus the new generation vessels, which are all the vessels that were designed afterwards and built, I would say, from 2013 onwards. And the reason why it's a technology shift is that, the liner companies in 2009, when that market crashed at that time, what they did was that because before that, it was all focused on high speed, a large container ship should run at 22, 23, 24 knots, because the focus was it has to be as quick as possible from one point to the next point to meet the schedule. But of course, in shipping, and that's of course one of the issues in shipping, is that you're in effect pushing mass through water. There is a lot of resistance. So to run a ship very quick, you have to build it relatively narrow to run it fast enough with a big engine. So when after 2009, the liner companies, what they then did, they slowed down the speed because the fuel consumption is exponential to the speed. So reducing say speed by 25%, you typically cut your fuel consumption in half. So instead of running them that fast, they instead cut down the speed and put another vessel or two into sort of a string, sort of a round trip string. What that meant is that if you don't need the speed, it's much more efficient to have to build a wider vessel with a smaller engine from a fuel consumption per loaded box. So it was very sort of basic, but that also means that if you invest in a vessel built before old generation vessels, as we see it, you have to bear in mind that it will always be handicapped with a much higher fuel consumption per loaded box. The same thing we saw on the dry bulk side, but that's further back. That's typically back in the 80s, so not too many people want to or can or will remember that far. But you've seen similar dynamics in segments. And of course, now you have the dynamics with the ESG focus, the transition to new fuels, which of course will have an impact on long-term value of assets, depending on which type of technology you end up choosing, whether you go for conventional and assume that you can upgrade and modify later, or you invest in, say, dual fuel technology that may look great now, but maybe in 2 or 3 or 4 years' time, you have another variation where what you thought was the most efficient may not be so efficient after all. So we have a team that's looking very hard on that. So, this all goes into the investment thesis of trying to do the right deals. But most importantly, what we do when we make an investment, we typically combine it with a longer-term charter. i.e., so typically we do at least 5 years, 7 years, 10 years. We do 15-year charters, I believe, is sort of the longer we've done. And what you have to assume during that long, period is that, there will be underlying market cycles. Our customer will see volatility in the underlying market. And that is why, chartering a vessel to, call it another operator, who may have, a lot of financial leverage, means that there is a higher risk of that charter or that deal breaking in the down cycle because they're not able to pay. What we have been focusing more on is to charter our assets to end users, liner companies and others, oil companies, etc. Because, these companies typically have higher economic resilience, better flexibility, and therefore ability to pay the agreed charter rate also in a soft market where they may not earn that much in the underlying market to cover your hire. But at the same time, when you have a longer-term charter, they also get the benefit of a higher market. So this goes both ways. But if we do a long-term charter, our counterparty takes all the benefits on the upside and then goes bust on the downside, that is really bad for us. I mean, that's when we, give away the upside and absorb the downside. And that's what we have to be quite careful about.
What's the worst scenario that could play out that affects your business? Because I was reading through your reports, and I mean, you list up a lot of risk factors, and we talked about the cycles, of course, but you also explained, the way you handle that cycles. But if you just look at financing, right? I was reading like a paragraph about, swapping interest rates, currency back and forth. Is there something like in the financial engineering that you need to be aware of when you're dealing with these big numbers, or is it just but basically balance sheet optimization, or is financing also a very sophisticated play to master in order to run this operation?
Yeah, of course, financing is important. Our mindset is that it's not our business to take call it interest rate risk on behalf of our investors. I mean, if they want to play sort of on the interest rate curve, they can do it themselves, I'm sure. So what we typically do, if you do a new deal, we typically hedge out the interest during the charter period. We also have some charters where we have agreed, interest compensation, clauses, i.e., where our customer is absorbing, call it the interest rate movements. Of course, that's been phenomenally, attractive in the very low interest rate environment we have seen up until recently. But now, when we see interest rates coming up again, we have the benefit of having most of our exposure fixed, from an interest rate perspective. We don't do really currency as such. I mean, what we have done, we have now two Norwegian kroner denominated, bond loans, unsecured. So what we do when we have entered into those, we do a cross-currency swap, which means that we are neutral to currency movements. We basically, buy the dollar forward the kroner forward. So we have a dollar economy in the company. And then we have, a funding mix. And one other maybe interesting observation, I mean, we look at diversification on the asset side, but we also look for diversification on the funding side, because we see that similar to the asset side, the funding market also goes in cycles. So we've done US straight bonds, we have US convertible, we have done Nordic straight bonds, we have done, call it environment-linked bonds, in addition to bank funding. And of course, bank funding has always been sort of the stable type of funding source for many maritime companies. But if you look at our mix, if you go back 10 years, you would have seen that we were, to a very large degree, funded by Nordic banks and European banks, and had very limited interaction with Asian banks. And also US banks, apart from the bond market, hasn't been that significant in the maritime space. Now that's been turned upside down almost. Now we have predominantly funding in Asia. We have also still a good chunk of funding in Europe, but we have very limited funding in the Nordic banks on the shipping side. So, and this has been a strategic, important, for us to develop those relationships, in Asia, it's in China, it's in Japan, Taiwan, where we have built up long-term relationships. And what we have seen is that many of these have, what they really value is the long-term mindset, or focus. We don't play the spot market. We look at long-term sustainable businesses and resilience in our structure, and which means that we have long-term performance. So I think we are the only maritime company that's been operationally profitable every single quarter from inception. If you look at anybody else, everybody through the down cycle have lost a ton of money. We had one quarter where we did not have a positive, net income, and that's when we took a book write-off on a drilling rig. Every single quarter apart from that, we've been profitable. So you could say over time, I think, if you look from an investment perspective, I think we have delivered 12.5%, consistent return from day one for our investors, and hopefully we will continue to perform well also going forward.
That's super impressive. Another point I want to discuss briefly is the importance of reputation, because obviously, as you mentioned, the major shareholder in this company is also a major shareholder in other companies sitting right next to you, basically in the office. How important has it been to be, have a great reputation? And when you lease, maybe some people can think that, maybe it's easier to get a good deal when you share the office space versus, a deal across continents. So how important has it been to find, the right balance in terms of not getting any conflict of interest? Or is that not an issue at all? It's super easy to avoid that. Or can those issues arise just because people may think they arrive?
Yeah, well, it's of course it's a very valid question. We share office space with Frontline and Golden Ocean and Flex LNG, but what we share is reception services, canteen, and some back office functions where we own in a shared company, which is sort of the main things we share. We run it very separate. We have separate boards. As you mentioned, we have a large shareholder in the Fredriksen family. They own around 20% of the company, so we have 80% other investors, of course. So I would say it's run very independent. We have very limited related party business. It started as 100% related party, so that's been a very dramatic change, I would say, over the years. But apart from that, I would say that from an investment community perspective, I think Mr. Fredriksen has had a phenomenal reputation, because unfortunately in shipping you've seen too many examples of companies, listed companies, where management or the principal owners' main focus has been to enrich themselves, it seems, with fees to their own companies and skimming here and there along the way, S&P fees, management fees, sales fees, this and that. There is nothing of that in our structure, nor in our related companies. So it's always been, one share, one vote, one piece of the economics. So which of course is, from an investment perspective or investor perspective, I would say should be very reassuring. They've been extremely investor friendly. There have been, I'm sure, so many chances to exploit situations, but if you look at the Fredriksen family, I would say maybe they behave in a way like a fund or fund manager, because what they see is that if you start sub-optimizing, say if you have one company A and you have company B, if they want to do a deal because both of them think that this is beneficial for me, of course, then they won't, be opposed to it, as long as, corporate governance principles are followed. But if you start cross-subsidizing, i.e. you do a deal between the companies where one company say, I don't really want this, but I have to do it, it will reflect up on the value of each of those two companies. So you can say in the end, the value of their holdings will be reduced if you cross-subsidize from one company to the other. And then, going back to valuation, I mean, over time, consistently, if you just look at, call it the NAV, call it if that's a metric, you look at, typically companies in our wider group have generally been priced well over, call it what's called NAV, and certainly well over NAV compared to other companies in the same sector. And this I think is not a coincidence. It's because investors feel that, okay, if I invest here, yes, you could say absolute, I may pay, marginally more, but if the market moves, I get at least as much, because these companies are much more investable from a corporate governance perspective, and therefore will be more attractive also when markets, move upwards. So I think, the relationship here and having the Fredriksen family as a large investor is phenomenal for us, because it's given us a lot of, I would say, a lot of comfort, certainly at the early years, that we have access to deal flow. We have to remember that Mr. Fredriksen, in his career of more than 60 years now, I don't think anybody has done as many deals as he has over the years. So we have phenomenal access to deal flow, say on the shipbuilding side, with shipyards, but also in the shipping community at large. So, having that, call it resource, I would say, for our shareholders is great. And we have seen deal opportunities coming in, through him, where, if there is a long-term charter type opportunity, he would send them on to us typically.
That's a great answer. I know that this question is a bit hard to answer, but I mean, this is definitely a high performance system to work in. And you've been there for very many years. And if you just look at the reports, it's not given that you will have, this position for so many years. Do you have an answer to why you have been able to be here for such a long time and why you also enjoy being in this environment, which obviously is a high performing environment, right? So it's basically, I don't think you can come here and relax and just rest on your laurels, to say.
No, it's a good question. I don't have a good answer to that. I think it's a combination of the greed and paranoia, as I mentioned earlier, where you have, the only ones who should really celebrate doing a deal are the shipbrokers, because they get their fee when the deal is done. We should, as an owner, we should really only rejoice when the deal is over, when the charter rate has been paid, the ship has been redelivered, and sold or rechartered. That's the only time we should rejoice, because going back to the cyclical nature of the industry, what you have to expect is that things will happen along the way here. Whether that is the financial crisis in 2008, 2009, and back then, the company name was Ship Finance International, as you may recall. In 2009. Our name, therefore, consisted of the two things investors hated. They hated shipping and they hated finance. So that was an interesting cocktail in itself. Then you had the tanker crisis in 2011. Then you had the offshore crisis, and you had the dry bulk crisis on and off here. So this is a market where you just have to manage through volatility. You have to try to buy the right assets, charter it out to the right people, and manage it along the way. And I think hopefully a combination of that. Hopefully our ability to deal also with situations that don't develop as we hoped for initially when we made the investment, deal with it early and not pretend like it isn't there is maybe an important factor. But I have a great team. This is not just me. Very professional team, very motivated. And we have fun at work. It's interesting. It gives a lot of energy.
Yeah, because that was the next question, because we talked a lot about greed and paranoia, but don't you also feel it's a case about that sort of the Buffett saying that you also should be able to tap dance to work and really enjoy yourself? Because being in this environment, I mean, you can lose sleep over bad deals, right? But I don't think losing sleep for many months or years even it's a good path into high performance either. So in some sense, you also need to enjoy the pressure, enjoy the opportunity you have to make a difference, because when you run these operations, like a good operation also means a huge value creation, right? And maybe that's also should be the focus when working in this environment.
Yeah. So of course, I mean, we've just been through 2 restructurings in Seadrill, right? Which has been, taken a lot of energy, taken a lot of resources. But at the same time, along the way when we were through that, because if we had been only invested in offshore assets, of course it would have been, horrible. But of course, now we've been also invested. We have more container ships than offshore assets. So, part of the portfolio has performed really well, while some of the portfolio has been challenging. And of course, you have to spend the time, you have to do everything that's required. But when we look at new deal opportunities, you have to have that energy. You have to think that this is going to be it. This is going to be the new deal. This is going to be great. And then, of course, as you call it, dissect the sort of a deal opportunity, and you go through it, and you look at the various sort of risk reward parameters, it may or may not materialize. As I said, last year, $1 billion out of $19 billion ended up actually being done in the end. You have to have that focus that the next one, that's a great one.
That's a great way of putting it. If you look at, we're sitting in Oslo in Norway, but the company is listed in New York, and it's not listed here in Oslo, so that makes it a bit interesting. So what would be the difference in you sitting in New York and running the operation from New York, closer to the shareholders, which I suspect is mainly US investors, right? But there is probably a big trade-off on good and bad side. But what would be the difference? And has that ever been a discussion of running it from US? Or is it better to run it from Norway?
Well, we haven't sort of discussed it so specifically. I think it's not that important necessarily where you run it from. What's important is what kind of deal flow do you have access to, and can you go where you need to go? Remember, we do deals. Our customers are to a smaller degree in the US. We have many more customers in Europe and Asia. So from that perspective, you could say being in Europe, and then you can say, should you be in Oslo? Should you be in London? Should you be, in some other city? I think in Norway, at least what you have here is, call it an underlying, mindset, I would say, from, in the business community, that shipping has always been and continues to be sort of an interesting place to be. I think we attract good talent, because that's the dilemma. If you're in the US, shipping is such a marginal business. And I would say, I wouldn't, up until, say, a few years ago, it didn't. I mean, if you were the smartest, kid out there, you wouldn't go into shipping, right? You would go into tech or some other cooler segments. So, which means that, you have a lot more people, but you don't necessarily attract, better talent individually, I would say. So in a small country like Norway, where shipping has always been big, you have access to resources. Of course, you get access to good resources elsewhere as well, but it's a cost-efficient way. We have some people working, out of Oslo. We have some people working in London, and we have a team, of course, also on Bermuda. So, we could easily run the company from the US, but, as it happens, it works well to run it from Oslo. But importantly, no business decisions are taken in Oslo. We do the administrative work. Decisions are taken, through the board on Bermuda.
Just a final question on sort of where to operate and where to be listed. So, what's then the trade-off of being listed only in US compared to being listed in Oslo as well as many other companies in the Fredriksen system is, right? Because that's something that, I haven't worked in this field, so I've never really understood the calculation and systems behind should you be listed in 2 stock exchanges or only 1? So has there ever been a discussion at all?
Well, yes, it has been discussed. What I would say, you have to go back to sort of the basics of these companies, because if you look at most of the if you call it the Fredriksen Group companies, companies like Frontline, Golden Ocean, etc. They are very much spot-oriented companies, where they are exposed to the market volatility. SFL, on the other side, has more longer-term charters, and it's therefore not that exposed to spot market. And this is back to sort of the structure and why the company was set up. It was set up based on the OPCO-PROPCO, call it separation theory, where you have a focus on yield investments and yield investors in SFL, versus the typical shipping companies in the US have been more hedge fund, private equity type investors who have been more attracted to it. In Norway, those who invest in shipping has typically been sort of the hedge fund-like investors, those who want to buy in low and sell high, which has been, of course, what they all hope for, and not so much sort of yield-type investors. In Norway, that's been more focused on real estate, and because shipping has been so cyclical, and it's so cyclical in people's mind, I think for many, combining shipping into a yield vehicle in Norway hasn't been so attractive. Also, with our shareholder base of around 60,000 investors in the US, we've always had very significant, share liquidity. I think we have around 1 million shares, or say plus minus, 50 to $60 million per day, per week, volume in the US, whereas most shipping companies have had very thin liquidity from time to time. So it's never been important for SFL to be listed in Norway because I'm not so sure that it would really add so much in terms of liquidity in the stock, in particular. So we believed well in the US, and we've had consistently good liquidity also in down markets where we have seen other, call it, shipping companies had virtually not. I think the issue we all have in the maritime industry is that there are too few large corporates in the market. So, for instance, in the US, you have to be at least $3 to $4 billion, to go into mid cap. So all shipping companies are, I would say, most are micro cap, well below $1 billion market cap, which for many funds in the US is a bit uninvestable. At least with our market cap of around 1.3, and of course with that dividend history, we get into some of the indexes like Russell 2000 and others, where we are of course part of the investment community, but still I would say on the small side. If you look at the potential business combination between Frontline and Euronav, for instance, that will create, I would say, a much more interesting vehicle in the tanker space. It will make it much more investable, I think, simply because of the sheer size and the fact that it will be into more and bigger indices, and will perhaps help shipping come over the hurdle of being too small and marginal. And of course, as you've seen in the Norwegian equity market or in the Oslo Stock Exchange, a lot of the companies have typically been very, very small, and therefore you won't get investment banks to really focus on it. You won't get the analyst coverage, etc. And that's a negative dynamics. Of course, right now, things are a little different. You have several segments that are booming. Your container ships have been phenomenal over the last couple of years. Dry bulk has picked up significant. Everybody's waiting for the tanker market. They hope that, a year ago, everybody expected it to come around next corner. Let's hope that corner is now. So I would say, right now, and offshore is also coming along. So I would say, historically, it's never looked as good as right now. Which, of course, the paranoia side of my brain says, be a little careful now, because we may see some more volatility.
Great answer. If you just look at the fleet like a bird's eye view, can you give us a sneak peek into how big the fleet is going to be in your mind? We are around 70 right now. Are we looking at 3 digits, or is it about this is a good balance, or let's just trade in and out around these numbers? Or since one of the keyword is growing, right? Is there an end station in terms of how many assets you can handle, or is it just building a pyramid one brick at a time?
Yeah, it's really one brick at a time. A number, that's just a number. You could say you can have smaller ships and a lot of them, and you can have bigger ships. So for us, it's all about investing the right capital in the right type of assets, and growing, and buying more than we sell, and thereby building the distribution capacity. That's really everything that matters. Whether right now we have an enterprise value of around $4 billion, we could easily $10, $12, $15 billion without necessarily becoming too big for the market as such. But we don't do that just for the growth. It has to be because the deals are the right deals to do. And of course, if we had bigger scale, we could also have access to some other capital sources that we're not utilizing today, of course. So it's a balancing act. But get the right deals done, and be careful always, and have greed, also on the other side of your brain half, and hopefully you can combine the two.
If you just look at the fleet, is there any type of assets you would love to buy that you haven't bought yet? Because I was thinking about this, and one example that came to my mind, I mean, it's sort of like, doesn't make totally sense, but why not, is well boats, which has been a gigantic industry. And it's also asset heavy, it's expensive to buy, and it's also, a connection through seafood, which Norway also has great reputation on. So do you look at those other type of assets, like well boats or others, that maybe one day could make sense? Or is it too far out there and too niche in the industry?
No, I mean, we looked at many, call it segments outside sort of the mainstream tanker, bulker, container ships. You looked at that. LNG is another, for instance. You have LPG. You have many sort of product. Many segments here that you could look at. It's all about getting the right deal done with the right type of risk reward. What you've seen, for instance, on the fish farming side, on the well boats, is that there's been a significant technology development. So, similar to wind farm installation vessels. What was a great installation vessel 3 years ago is too small now, right? Because you have a growth in size. So that, of course, goes into the risk evaluation. So say if you build an asset that's supposed to last 25 years, say, and you have a 5-year contract, which means that you have 20 years of remaining life. You have to ensure that you can get a good return on your capital also in the later 20. You have to keep in mind that this the asset may have to be significantly upgraded or rebuilt or maybe obsolete well before that theoretical life cycle. FPSOs over the years has been something we've looked at a couple of times. There you have typically long-term charters to oil majors, significant cash flows, etc. But the dilemma with an FPSO is that it's typically very sort of field specific, i.e. it's tailored for a specific field with equipment on board, etc. So it's not like you can move it to another field with a snap of a finger. You typically have to rebuild it significantly. If we had full payout charters, for that initial charter period, it would be easy. But typically in most of these deals, you have to accept a significant residual value exposure, which is, what I referred to in, how do you manage the rest of the life cycle? And, we can only comment on the deals we do, but I'm fair to say we've looked at many other segments as well.
Very interesting. Just a last topic with some short questions about, career advice and hiring, because you hire a lot of people, you see a lot of people come in the industry, you see some people move away from the industry, right? So given your data sets and all your experiences, what do you typically try to say to a young person in their 20s or 30s who really want to have a great career in shipping? Do you give any general advice, or do you say that this is your own journey and you just have to find a passion and just stay in the game long enough to get good?
Well, I think it's all about passion. I mean, to anyone who wants to get into any career, go with your heart, because that's when you do a better job. If you go into a segment or, just because you feel that I have to do this because otherwise, I won't get the right job or I won't get to the right salary level, etc., you typically aren't as motivated. And if you love shipping, and if you look at sort of the shipping, it's typically been dominated surprisingly by from Greece, from Norway, you could say relatively smaller call it countries, compared to China, for instance, where you had a much bigger call it industry base and where you have much more transportation needs. Shipping hasn't been that much of a focus area. So I think if you want to get in, start. You have to get in. You have to start somewhere, and sort of build your way through it. Career-wise, but go with your heart. More important than focusing on a specific sector.
But when you hire people, what do you think? Have you become great at hiring and identifying talent, or is that always super tricky? Because you can ask people questions about what they think about the business case, etc., But to see them work with the actual problems, it's not necessarily, the perfect match of what you thought it would be. So hiring has to be super tricky always.
Always. And even professional, headhunters typically say that, if you have more than 50% success rate, you're really good on that. What we have done, we've typically hired based on, people we have seen, working, or where we have good references. We haven't hired that many sort of directly from university. But of course could do that as well. But it's a relatively small team, so it's extremely important that you find the right people, the right you could say, and people both skill wise, but also people who sort of fit in culturally. That you feel can contribute to what we say the energy in the organization in any of the offices, not. I don't really have any specific advices for how do you get in position for that.
But it's basically about building a track record, right? Because you also have to try. I mean, it doesn't matter where you start. You sort of need to get your nails dirty and get into the processes and work with it, right?
Yeah. And what we've seen is that, of course, coming from university, with a great CV, that's one thing. But it's really when you start working and you sort of get into the details, that's really when you can sort of really see the difference between, a good performer and a super performer. Right? So, but I think we've been quite lucky in recruiting in SFL. We have a highly motivated team, very good energy. Even when the offshore market was storming a little bit, 2 years ago, we had very good energy here, very focused on, we'll do this, we will manage that type attitude, and I think it's paid off.
That's a perfect ending, Ole. Thank you so much for taking the time. It was a pleasure having you on.
Thank you.